But now they're even pivoting and selling IUL because they're trying to buy into this conversation about the strength and the stability of these insurance companies. If you knew you could get on a plane and it was a 99% chance it was going to crash, would you get on that plane?
Heck no.
That 4% can go up and down. That can adjust your options budget. And then the cost of options can go up and down. If you're going to do it with whole life insurance companies, when digital assets become a real viable, usable product, they will shift away from the fiat stuff they have and they will make the transition for you. IUL, it's the most misrepresented product in financial history.
Welcome back to the show, everybody. Man, today is kind of surreal for me to have this man on the show that I am about to interview, because most of you know me for infinite banking and what I talk about with life insurance, using it to make your dollars more efficient and multiplying money, all that stuff. I learned about that concept March of 2020 during COVID. When I learned about it, my head exploded. I was like, I've got to learn more about this. I went down a rabbit hole. I was watching every YouTube video I could find, and this man was one of the main people I listened to and watched on his YouTube channel, Life 180. And just crazy to think it's come full circle. About 3.5 years later, we met a year and a half ago at a symposium for one of the insurance companies. And just a solid dude. We started talking, lot in common. We've done some content together. And it's cool to have him on the show because we're going to talk a lot about infinite banking, which I know you guys want to hear about. We're going to talk about some other really cool stuff that you guys will get some kicks out of. So stay tuned for that. But it is my pleasure to introduce to you the one, the only Chris Kirkpatrick. Welcome to the show.
Thanks, man. It's so funny you say the one and the only because my name is actually kind of the bane of my existence. Chris Kirkpatrick is actually Justin Timberlake's #2 on NSYNC.
Yeah.
And so like whenever you type in Chris Kirkpatrick online, like I'm always fighting against a boy band member, but.
He's the one that had like the red hair, right?
Yeah, and like Eminem in 2002, I think, launched that song, and in it he said, Chris Kirkpatrick, gonna get your ass kicked. And of course, everybody calls me, from college and high school being like, dude, what'd you do to Eminem? Like whatever. But
oh, that's so good.
Yeah.
But so, you're the real Chris Kirkpatrick.
I am the real Chris Kirk. I'm the one who's like making a difference in people's lives at this point in time.
And not singing.
Hopefully.
Not singing and
dancing
around.
Nobody wants to hear me sing.
No one wants to see you dance?
No. No, unless you want something to laugh at, but
So good. Well, let's tell people a little bit about your journey into infinite banking, because it started off as one of the top producers for IULs, Index Universal Life.
Yeah,
right?
I got into the business in 2009, just after the Great Recession. I got in thinking I was going to become a financial advisor. My father-in-law was a financial advisor, fee-based planner for all the big companies like A.G. Edwards, Wachovia, Wells Fargo. Like he kind of went through those ranks. And in 2009, the recession happened. My wife and I moved back to Vermont, where our families are from. And we just decided I wanted to get into the business. And so I went in, and he wanted me to be a succession plan. He had been in the business about 30 years at that point in time and was like, why don't you just come in? I'll get you an interview. We can make it happen. And I did. I went in. And his boss, Ray, was like, listen, Chris, I think you're going to kill it. I think you're going to be great at this business. But in case you haven't looked around, the economy isn't really good right now. And if you haven't had a job, because I was playing poker for a living before this, right? And so he's like, you haven't had a job in 7 years. If I hire you in this economy, they're going to fire me. And I was like, well, that sucks. What do I do? And he's like, go get a job at a life insurance company. They'll hire anybody. And so I was like, all right. And so I literally went down the road to a company that's the largest company in Vermont. And I got a job with them and became an agent, fell in love with Index Universal Life. So much to the point where, and I had so much success early and drank the Kool-Aid that 6 months in, I went to my father-in-law. I was like, hey, by the way, that succession plan, it's not going to happen. Like, I'm going to do my own thing because I believe in this. Now, fast forward, 4.5 years later in 2014, when I realized like IUL wasn't everything that I thought it was. Imagine how hard it was to go to my father-in-law and say, hey, by the way, remember that thing that I didn't join you for? I went this direction.
Yeah.
I was wrong.
Yeah.
So like there's so many levels to it. But yeah, so I got involved, started doing Index Universal Life, started off as an agent, became the director of business development for the company. And my job was to recruit agents and teach them how to build their business and
teach them how to sell IULs.
Teach them how to sell IULs, baby. And it's so funny because it's one of those things like on a surface level, I understand why they're so sexy and so appealing and why there's so much clickbaity content around it all that makes it sound so appealing.
Right.
The challenge is the deeper I got, the more I realized that it was all a smoke and mirrors game, and that the whole purpose of Index Universal Life was to shift the risk from the insurance company to the policyholder. And to me, that was completely opposite of what I was trying to preach and what I was teaching people and what I was telling people that they were buying. And so that was challenging.
Let's stay on that because I talk about that a lot with whole life. If it's structured properly for infinite banking is there's no risk. The risk is on the insurance company because take, for instance, one of my policies, I think the first big one I did, it was $125 a year. That's how much I put in. So I put in $125 the first year, the death benefit, $7.6 million. So I put in $125.
Yep.
If I died the next day, the insurance company has to pay out $7.6 million.
Totally.
But I only put in $125.
Yep.
They have so much risk.
Yeah.
Over time, as I keep putting that money in and they can take it and go invest it to make returns and be able to pay the death benefit, their risk shrinks.
Sure.
Right? So talk about why that is different with an IUL, why the insurance company is taking the risk off them.
Well, it's not just the death benefit side, it's the moving parts inside of the policy. So when you buy a whole life policy, like you said, I always equate it to trying to simplify the conversation of with a whole life policy, what you're getting is you become effectively a business partner with the life insurance company. Right? So when you get paid a dividend, you're putting your money in the life insurance company's general fund. They're managing those returns. And then your dividend is basically a dividend paid out on the profit share of the return of premium, right? For all the profits that the life insurance company is making across the board. And so your success as a policyholder is directly tied to the success of the insurance company. They're inseparable.
So they're making decisions on your behalf, basically. They're trying to make you more profitable.
And so as a policyholder, you have this direct correlation of saying, man, I want the insurance company to be profitable. The more profitable they are, the more profitable I am because I'm going to share in that success. And that's a beautiful thing when you think about the ability to partner with a company in that way that has been literally successful every single year since 1840. Right? That's pretty powerful. There's no other financial institution or sector of the finance world that can do that for you.
Through World War I, through World War II, Great Depression.
Dude, the Civil War.
Everything.
Like the Civil War. Like, I know everybody's freaking out right now about the world and politics and all the things that are going on. I don't know if you want to go there, but like at the end of the day, I promise you it's not going to get worse than the Civil War. Right? Okay, like I think we can all agree on that,
100%.
And so life insurance companies even succeeded during that time. We've gone through 3 different versions of U.S. currency during that time. They've managed a transition for all you Bitcoin people out there and crypto people. I don't mind crypto. I love crypto when it's done right and expectations are in alignment. Life insurance companies, when digital assets are a viable thing, whole life insurance companies are going to manage that risk better than me. That's my belief. That's the beautiful
100%.
part about having your money in a whole life policy. It's tied to fiat currency now because that's what makes sense. But life insurance companies are going to manage that risk because that's what they do. And so when you put your money there instead of a bank, you're mitigating so many more risks that most people don't even realize that they're doing. Right? And so and I know that wasn't the full question. The full question was, why is it different with IUL? Because all those benefits that I just talked about with whole life go out the window when you put your money into an IUL contract. And that's what really pisses me off when I see all these crypto guys now. I'm thinking of a couple of them. Specifically, I'm not going to name them, and it drives me freaking crazy that they're out there pitching and hawking IUL now just because it's a cash flow opportunity, right? And it's totally out of correlation with their own values and their own beliefs and what they're preaching on the crypto side of things. You put your money into an IUL, you are no longer a business partner with the IUL company. You are a profit center for the life insurance company. That is the functional difference. Right. And so all the benefits I talked about sharing the success, goes out the window. And that's the thing that drives me nuts. All these IUL agents speak out of both sides of their mouth and they go, oh, life insurance companies, have been the most successful institutions in the world. And that's why you should put your money in an IUL. Well, guess what? That has nothing to do with anything anymore. Like I promise you can put your money in an IUL and the life insurance company, I promise you, will still be here 100 years from now. Right. Succeeding. And they'll do so off of your tears.
That's the thing is, life insurance companies, they're super smart. They literally manage risk.
So I think one of the things that people need to understand is when we look at whole life insurance and when we look at, all right, what do we want to do with our money? And you have options. You can say, I'm going to keep my money in a bank or I'm going to keep my money in a whole life policy.
Right.
Those are ultimately the two most common connections. They have the most similarities as far as the way the accounts and the liquidity and the growth and like the safety and what people are looking at. That's why we call it infinite banking, right? It's like a whole life policy is a banking alternative.
Right.
And so if we look at, all right, I could put my money in a bank, well, you're now tied into the fiat currency system. If you look at a whole life policy, you are participating, that's why they call it a participating mutual company, in the profit of that company with a company that's been successful every single year, has paid a dividend every single year, and has been profitable every single year since 1840, right? So I challenge anybody to find another company in the world that can claim that.
There isn't.
It doesn't exist, right? And so when we go back to 1840, you think about it. I know a lot of people are worried about what's going on in the world right now, right? With politics and losing the world's reserve currency status. And, I think it's completely garbage as we're recording this, that the stock market just hit a record high, and all these things. That's fine, whatever. But as I know a lot of people are worried about the world kind of going to hell in a handbasket, so to speak. But if we go back to the beginning in 1860, right, what happened then? The Civil War.
Right.
Life insurance companies were in their infancy, only 20 years old, but because of the way they do things, they were still profitable. So I promise everybody right now that it's not going to get worse than the Civil War. If you think it's going to get worse than the Civil War, you probably should just move to an island like me, but it's
get a bunker.
Exactly. Get a bunker, go to New Zealand, do what the multi-billionaires are doing and buy a bunker in New Zealand, right? Go do that. At the end of the day, being able to have your money with a whole life insurance company is basically saying, hey, I trust that you're going to manage my risk from a long-term perspective. And when I say manage risk, I'm not just talking about profit and loss. I'm talking about currency risk. I'm talking about, total economic calamity risk.
Yep.
And it's important to understand that since whole life insurance companies have been around, there's been 3 versions of the US dollar. They've managed every transition. So it's one of the things that drives me nuts right now is all the Bitcoin people, right? All the crypto people, all the digital currency people that are like, oh, the US dollar is going to be replaced. Oh, there's an agenda to replace all of the currencies with some sort of world-backed, digital currency or whatever it is. I choose to not focus on that because A, I can't control it. B, as smart as I feel like I am, I'm not that smart, right? And you know who is that smart? Whole life insurance companies. This is what they do, right?
100%.
And so the thing that really pisses me off though is you get all these influencers on YouTube, on Instagram, TikTok that are out there pitching all the cryptocurrency stuff, which, okay, cool, no problem. But now they're even pivoting and selling IUL because they're trying to buy into this conversation about the strength and the stability of these insurance companies. I got news for you. If you're going to do it with whole life, whole life insurance companies, when digital assets become a real viable, usable product, they will shift away from the fiat stuff they have and they will make the transition for you. That's why I'm doing it, because I think they're going to be able to manage that transition more effectively than I'm going to, right? If I had my money in an IUL, I would get burned while they took my money as a profit center to manage the transition to meet the guarantees that they have for all the people in the whole life policies, right?
Yes.
And so the problem with all these influencers that are backing crypto and pitching IULs. They're stealing and bastardizing the whole story and the conversation and the reputation and the goodwill and faith that these life insurance companies have built up over 180 years. And now they're bait and switching people. That's why I call, IUL, it's the most misrepresented product in financial history.
100%. And you say profit center for the insurance company. So I'm going to try to dumb that down, and
sure,
I'll explain it. You tell me if I'm wrong.
Cool.
Okay?
Yeah.
So you put your premiums into an IUL. They go into the general funds, and then the insurance company knows they can make, let's say, 4% every year. They know they can make that.
Correct.
Steady Eddie, 4%. So what they're doing, instead of you getting a 4% credit onto your money, your cash value, they're taking what they would have given you and putting it into index options. Okay. So then that index, if it loses money, they just don't credit you anything. You're not earning any money inside your policy, right? But if it grows, let's say by 20%, they have a cap of, let's say, 10. So they'll credit you 10%, keep the other 10 as their profitability to pay their guarantees. But here's the thing. They can lower those caps, right? So if they have an off year, they can say, you know what, 10% is a little too high. Let's lower it to 6, right?
Yeah.
So did I explain that correctly?
Yeah,
basically how it works.
I think you explained it great. I think here's what I'll say is that I've done a lot of content around this, and I don't think life insurance companies just lower caps for the sake of lowering caps. They have a profitability kind of metric that they're after. They're going to meet, and I think that's the thing with IUL is they're going to meet their profit metrics no matter what. Whereas with whole life, they're going to make sure you're made whole no matter what. That's the point.
Right.
That's the shift in the risk. And so when you put your money into an IUL, you called it right. You're putting the money in, it's going to the general fund. That 4% buys call options. But the thing that most people don't talk about is that the variables are that 4% can go up and down. That can adjust your options budget. And then the cost of options can go up and down.
Right. Okay.
Right? And so what happens typically in a volatile market, the cost of options goes up, right? And so what happens is as interest rates go up, which can increase the budget, and this is a little complicated. I usually do it on a whiteboard. But as the options budget goes up because the interest rate environment is going up, that creates more volatility because it increases the cost of borrowing for companies. And the idea, if you understand anything about fiat economics and the Keynesian economic theory, is at interest rates, you rise and increase interest rates to suck money out of the economy. When you suck money out of the economy, that means you depress the asset values, right? Technically speaking, real estate values should go down a little bit. Stock prices, valuations will go down a little bit, or at least level off, right? But when you do that, that increases volatility. When you increase volatility, options costs go up. All the while, underneath that, you're creating this spectrum on the policy that is just like setting up for self-destruction in these IULs. And all the while, it's on a universal life platform with it, which is annual renewable term for a policy that can't ever be paid up. And the older you get, the more expensive it gets. And if all the things don't work out right, listen, here's what I'll say. It's not that an IUL can't work, because in a vacuum, it can, right? It's just that 99% of the time it won't work. Right. So I ask you, is if you have a 99%, if you knew you could get on a plane and it was a 99% chance it was going to crash, would you get on that plane?
Heck no.
Hell no.
Not a chance.
Not a chance, right? And so why would you put your money into an IUL then? Right?
Because there's no downside risk and upside potential.
Right. So, and I did a thing called the IUL challenge, and it's been going for almost 2 years now, right?
Yeah.
And nobody's had the balls to step up to the plate and actually debate me. I've challenged Doug Andrew to a debate live. I've challenged David McKnight to a debate live. I've challenged Curtis Ray to a debate live. Those are the three biggest, kind of most influential IUL people, and every single one of them likes to clap back at me on social media. But when I say, hey, listen, I'm all about transparency. Why don't we just connect and do it live? You know, I'm all about, like, if you're so right, this is your opportunity to make me look like an idiot.
Right.
And to prove your point. Every single time they all back down.
Guys, the thing about an IUL that you really need to understand, and you just said it, there's all these moving parts.
Yep.
So in a vacuum, it could work. Like if, let's say, you're earning, they illustrate really well because they're showing an average return of the S&P 500 or whatever it is. Right?
Yep.
Average is different than actual.
Sure.
For one. But all these different moving parts, it has to go perfect for these to work.
Yep.
Whole life, there's no moving parts.
Right.
You have a level premium,
Yep.
guaranteed. It'll never change. Contractually guaranteed.
Totally.
Level. It'll never go up. And then you have guaranteed minimum growth. Most companies are 2 to 3.25.
Yep.
So if your cost never goes up, but your growth never stops and goes below 2% on the lowest end, that's without dividends.
Yep.
And as we've touched on, these companies have paid dividends every single year for over 100 years. That means you're going to grow more than the guarantee. If it never goes up in costs, but the growth never stops, guess what happens? It's predictable. You know exactly what it's going to do.
Totally.
And that's why it's good for infinite banking, because there's no guesswork.
100%. And that's really important. Like that is one of the most understated and not talked about elements of the value of whole life insurance. If you talk to any business owner, any really high level investor, and you ask them what is the number one key to your success, it's predictability. That's what investors want, is predictable market environments. That's why we create more volatility in the stock market. That's why, people start sitting on their money. And when there's all these unknowns, when we hit an election year and all these things are going on, nobody knows what regulations are going to be passed and how that creates an unpredictable environment. And so smart money sits on their hands when all these unpredictable environments kind of get introduced into the economy. And so that basically is a predictable environment would be whole life, and an unpredictable environment is IUL. And so I got news for you. Like in a vacuum, IUL can work, but if after looking at all the facts and all the moving parts of IUL, and when you look at that, if you still believe it, you probably also believe that unicorns exist and can fly and all these things, right? So
I used to believe that when I was 5.
Exactly. I was talking to my daughter who lost a tooth yesterday, or my son. My daughter and my son are sleeping in the same room right now as we're transitioning, right? And so my daughter, listen to this. This is crazy. So my daughter loses a tooth. She's 5. She lost 2 teeth in the last week. And my son comes to me. I'm driving him to school. And he goes, "Daddy, the tooth fairy's not real." I go, "Whoa, what? Like, what do you mean? What do you mean the tooth fairy's not real, buddy?" He goes, "Yep. So last night I heard the door creak and I saw Mom come and put $1 under the pillow for Kierland." And I'm like, "Oh no, that's a heck of a way for your kid to learn." But
quieter with the door. Come on. But guys, here's one thing I'll say about an IUL versus whole life when using it for infinite banking, and this is what I tell clients all the time.
Yeah.
The reason why a whole life should be used and an IUL shouldn't is with infinite banking, all it essentially is at its foundation is making a spread on money. That's it. So if, let's say you put your money into a policy and the insurance company charges 5% to borrow the money, borrow the funds. So you're controlling that money for 5%, right? All you got to do is go make more than 5% with the money and you've made a spread, right?
Sure.
So therefore, you should always be using your cash value. It should be out working for you, making that spread.
Yeah.
So if you do that with an IUL, let's say I've been using an IUL and now I'm 60 years old. It's on a universal platform, meaning it renews every single year with term insurance. Every single year, I'm closer to dying.
Yep.
Therefore, my cost of insurance goes up exponentially the older I get.
Yep.
So if the cost is going up like crazy, my money, my cash value is out working for me, and the company has a down year. I don't earn anything because there's no growth.
Yeah.
How does the cost get paid? I have to inject more money into the policy just to keep it from lapsing.
Sure.
Because I've got none in there because it's out working. I can't use my cash value.
Yep.
I've got to inject more into it just to keep it from lapsing. Policy with whole life, if all the money's out there working, by the time I'm 60, the growth far outweighs the cost of insurance.
Totally.
So the year when the growth hits at the end of the year, I can just use it to pay my premiums and I'll have some left over.
Well, I'll say this though, on top, not though, and certain companies also allow you with whole life insurance to have the policy completely paid up, meaning no more fees,
Right.
no more expenses, no more anything at either 65 or 75.
Right.
Right. And so, or there are options to do 10 pays, 20 pays, depending on your age. You can get more flexible, and it's infinitely more flexible than people give it credit for. Because that's one of the things people lean on with IUL. It's more flexible than whole life. Only if you do whole life wrong, you
Right.
know, like whole life. I mean, IUL is more flexible all the way around. It is, but not that much more flexible if you really know what you're doing with whole life, right? And I would say if you're the kind of person that needs the flexibility that IUL offers, there's an old statement my wife and I use a lot. It's just because you can doesn't mean you should. And ultimately, that flexibility that IUL provides is what typically winds up to be the downfall of most people.
It puts stress on the policy.
Right. And so there's that. But, you know, the 65 and 75 age, you can have the policy completely paid up. I think that's one of the mistakes that I see people make, and it's not a mistake. It's just when you do when you have the option to have a policy paid up at 65 or 75 or at a younger age, you know, based in alignment with how the person wants to use it. If you do a policy that pays up at 100, well, you still have, you know, some moving parts that, you know, could be tricky with whole life, depending on how people want to utilize it in retirement. You know, and that's okay. It's still going to be more predictable and more guaranteed than IUL because the costs are level, right? And that's the one thing in IUL that runs away from you, right? Like if you do an index loan with an IUL and there's a negative year, and then you have now all of a sudden you have $1 million in loans out because you've been taking loans for all this year, and then let's assume it was the market was positive every year straight for 30 years, and then
Which never happens.
Never happens, but like even in a vacuum and in a bubble, let's assume it did, right? And then 30 years in, when you're 75 years old, you've got $1 million in policy loans because you've been taking income from it for 10 years. And then all of the sudden, when you're 75 or 74 years old, let's say, you have a negative year in the stock market, and now you've got a 5% loan rate. Well, now you got $50,000 of extra cost, plus you have the costs for the insurance, which now you're 75, so that cost is even more expensive, have to be paid from the cash value in the policy. On even a flat year, you can. I've done videos that break down illustrations that show they always say you can't lose due to market loss, but you can lose because of market loss because of these other moving pieces and fees and expenses and charges inside of the policy. You can lose 10 to 20% on a 0% year in the market.
Right.
When you're in retirement, that's mind numbing, right?
That's when you shouldn't have risk.
Right.
And that's when your risk is going up.
And then that those expenses compound against you, and it gets worse and worse and worse from there. And it's you know, at the end of the day, people just read every line of the illustration for an IUL before you buy it, and I promise you just won't buy it.
The main thing I have people read all the time,
Yeah.
the guaranteed side.
Yeah.
Guys, on an IUL, the guaranteed side goes to 0. Mm-hmm. So they illustrate the non-guaranteed side with fictional.
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 Sure, fictional. We're just mixing words over here.
Fictional numbers of it illustrating at like 6%, 7% every single year, which we know does not happen.
Not going to happen. They assume every year is a positive year.
Which doesn't happen. The market goes in cycles,
Unicorn
right?
land.
So if the market drops, here's a great example. If you lose 50%, you have to earn 100% just to get back to 0.
Yeah.
So it's fabricated. It's the unicorn that it's always going to go up.
Sure.
And it's not.
Right.
Yeah,
totally.
It's just not possible.
Yeah.
With a whole life, it only goes up. Contractually guaranteed at least 2%, 3.25% with some companies, plus dividends. And these companies, they've been around since the 1800s. Mm-hmm. Think about this. Most companies in general, not even looking at life insurance, have not been around since the 1800s, right? Mm-hmm. So life insurance companies are the oldest companies in the nation.
Yep.
But not only are they the oldest, they're the most profitable, right? They've been paying dividends, which means they are profitable through every single year, every single economy, every single bird flu, swine flu, COVID, you name it, they're profitable.